banks have been out of fashion now for most of the year because of COVID and the concerns around COVID, the suspension of dividends, capital return, and fears around rates lower for longer. As we move towards a resumption of capital return, as you're moving towards whether it's dividends, buybacks coming back, led by the Swiss and the Americans, hopefully the Brits, that's going to help bank share prices.
One of the challenges, though, and you see this in the market and the VIX, is that we've had this spike in volatility, and it almost feels like investors are getting nervous again about the prospect of a spike in infections and governments responding by locking down economic activity. Doesn't that raise some issues about the move back into bank stocks at this point?
Oh, totally. Particularly given the spike in COVID cases in Europe and the UK, the big increase we're seeing, there's still uncertainty as to what the ECB are going to do around dividends. We're hoping that next year we can start again, dividends being paid back, reduce the cost of equity, get some interest in the bank shares. But there's still, it's not a done deal. The ECB will allow this to happen. And it's not unclear where the Bank of England and the PRA will go. As I said, the Swiss and the US have been a little bit more pragmatic on this topic.
Ronit, can I jump in and ask you about return on tangible equity, one of the key profitability metrics for the industry, and we've just seen it through the lens of Santander this morning. A woeful number reported for the 9 months at 3.3%. This is well down on the 10.5% number that we clocked up same time a year ago. But some of the destruction did come in the second quarter rather than the third, where we saw a slight improvement. What do you make of what we're witnessing? Are we through the worst, or do we still need to be concerned about return on tangible equity?
Sure. The sector has had a profitability crisis this year, and that's different to the last big cycles, the sovereign crisis in Europe or the US global financial crisis. Those were capital crises. The sector's gone into this downturn with a lot of capital. So the issue is really about profitability. And the first half was crushed, both in Europe and the US, by very high provisions. As we're sort of beginning to see in the third quarter numbers, Americans have come out, the Europeans are coming out now, provisions are lower. So there is sort of some improvement happening here, but it all depends on whether or not we get a second wave in terms of how much more provisioning we're going to take. That's still uncertain in the short term. The other big issue remains, if rates stay where they are, which is likely, you've got to do more in non-interest income, fee income, and restructuring your business, getting the costs down to have a higher return going forward. Consolidation is needed, as well as domestic in-market restructuring.